Hi everybody, welcome to our discussion on this topic, which is hedge accounting. Friends, we understand that there are primarily three categories of accounting for hedges, and we so far have been focusing on the first two categories. One is a fair value hedge, and second is a cash flows hedge. Right? Our standard, by the way, also talks about a scenario where either of the two, categories can be picked up, where we say that when there is a hedge of a foreign currency risk, right, an entity through its hedge documentation may decide to take it either through a fair value hedge or a cash flows hedge, right? We of course appreciate that any changes in the fair value of the hedged item as well as the the hedging instruments are essentially routed through P&L, but as far as a cash flows hedge is concerned, we keep it in the OCI as far as the changes in the value of hedging instruments are concerned till the time the maturity has happened. As a layman, as we have always tried to understand that. Now, importantly, what if there is a particular transaction where there is an instance of a foreign currency risk? Then how does the accounting happen in case of a cash flows hedge versus the accounting under a fair value hedge? That's what we would like to kind of try and understand in this particular scenario with the help of some example. We are given that there is a firm commitment. There are two firm commitments instead. There is a commitment 1 and commitment 2. Let's say there's a company called as company XY, which is a US company. Okay, it wishes to purchase some goods or inventory worth Sing SG dollars 1.15 million. Likewise, from another supplier, another goods of SG dollars 1.15 million. The maturity is both 2 months for the first commitment as well as the second commitment. The spot rate today is given as US dollar 1 is equal to SG dollar 1.15. So primarily my exposure is of US dollar 1 million. Okay, so that's what we have got here. Now, this company decides to classify the first hedge as under a cash flows hedge, okay, and the second as under a fair value hedge. All right, and there are also two reporting dates given at the end of month 1 and the month 2, where the spot rates are given of US dollar 1 is equal to SG dollar 1.10 and US dollar 1 is equal to SG dollar 1.05. Now, you shall observe that a US based company which has a functional currency which is US dollars, of course, when it is exposed to a foreign currency which is Sing dollars, it is of course concerned that the SG dollar may not become stronger against the US dollars, and for that matter, from 1.15 SG dollars for 1 USD, it has become stronger, or the US dollar has become weaker, because where 1 US dollar would have fetched 1.15 SG dollars, it can only give 1.10 or 1.05 Sing dollars later, which means that of course the hedging is in the right direction. The hedging would result into a forward contract, which is essentially an asset, right? So how do we assess that part is something that we want to do both for a cash flows hedge and a fair value hedge. We would certainly want to kind of spend some time understanding what happens basically when it's a cash flow hedge accounting versus a fair value hedge accounting, right? Now, before we do that, there's also a couple of information given. It says that the sale has happened for that inventory after 2 months of time for $1.3 million. Now, essentially, my exposure is $1 million and my sale is $1.3 million as the company XY. Okay, if you observe here, my spot today is SG 1.15 for 1 US dollars, which changes to SG 1.10. So when I look at the end of month 1, the spot movement comes at which is 0.05 basis points at an exposure of 1 million. This becomes 50,000 SG dollars, right? The US dollar equivalent shall be 50,000 divided by, of course, 1.10. Let's take that value from the calculator. That gives me 45454 US dollars. Okay. Likewise, at the period month 2, the spot movement has been from 1.15 to 1.05, which makes it, of course, 0.10 is the basis move, which is giving me $100,000 SG dollars exposure. The dollar USD equivalent, of course, would be 100,000 divided by 1.05. So this is the cumulative movement so far, and that shall come to 100,000 divided by 1.05. That results in 95238. Okay, so this is what we got, or we can also say the movement between the two periods is 95238 minus 45454. So quickly just picking that difference, that gives me a value of 49784 US dollar equivalent. Okay, now when I say I'm doing the first category of accounting, cash flows hedge, we want to understand how is the accounting done for this entire movement from today to month 1 to month 2 and even after the point of sale here. Okay, now my day 1 under a cash flows hedge, my today's accounting, there is no accounting at all. Precisely, we say that the fair value of the contract is 0. You don't really pay anything to get into this particular contract, so this value shall be considered as 0 straight away. Okay, now importantly, I move on to the month 1 accounting, where I see that at this point in time, dollar has become weaker against the SG dollar. The US dollar has gone weaker against the Sing dollar, which means that this particular contract in itself is a positive value, a decline in the value of the currency, and that is where you got a hedge against. The hedging instrument value becomes positive. So we say that this value 45454 is my forward contract credit, of course, other comprehensive income. That's a clear impact that we have under a cash flows hedge, because the hedged item is yet to arise. We haven't really made the purchase yet, so the hedged item is not available, but any changes in the value of the hedging instrument are routed through, of course, the other comprehensive income. Right? That's my first entry. Likewise, we do another entry at the end of month 2, where the US dollar has further declined against Sing dollar, which is SG dollar 1.05. So we bring this forward contract credit OCI once again. This differential of 49784, this starts arising at this stage, right? The clear objective is that this contract in totality has a value of 95238, and that's what is brought as a part of my other comprehensive income, right? Now, while I have this with me, I would now be doing a purchase of my inventory, okay, which means that this hedged item, the inventory itself, would be purchased at its spot rate. So we are saying that debit inventory, our total exposure is SGD 1.15. So this is 1150000 divided by the spot rate here. That's giving me the equivalent US dollar value. So when I take this value, it gives me 1150000 divided by 1.05. That brings a value of 1095238, which is precisely the extra value of this 95238. So this becomes US dollar 1095238 here. Okay, so if I say I'm paying it through bank, that's what we do, 1095238 here as well. But then against this payment of 1095238, I have a contract totaling 95238, which would now offset that extra payment here. Okay, so what are we doing here is that we are bringing this 95238 as a recovery. That's my cumulative gain so far. So I shall be reversing that gain and creating recovery of that through bank. So we say debit bank 95238 and credit, of course, my forward contract of 95238 here. We are precisely settling this debit and receiving the money. So this extra amount that we paid here is recovered by settling the contract right away. Okay, so once we have done that, this of course becomes my realization. Now at this point in time, I still have my inventory with me. Okay, but this inventory hits my P&L when I'm selling that inventory outside the system, which means that precisely my inventory still sits at 1095238 and I still have a gain of 95238 in my OCI. Okay, so when we are selling this inventory later, where of course this inventory changes into a cost of goods sold. Okay, so when this inventory changes into cost of goods sold, I'm saying here that debit cost of goods sold, which is my purchase cost 1095238. Okay, I of course have my sales. I'm selling these goods for 1.3 million, right? At this point in time, I have a privilege or a time where I would bring this OCI gain and adjust it against my cost of goods sold. The very idea of this movement from OCI to P&L is that when this inventory is hitting my P&L at the time of sale, that is a point when my cost of purchasing shall be reversed. Okay, so here my next entry that comes is debit OCI 95238, the cumulative gain that has been sitting so far in my OCI, that would be adjusted against my cost of goods sold, effectively bringing my COGS, effectively bringing my cost of goods sold to 1 million. That is truly the price I'm paying for this particular procurement. So that is how you would do it under a cash flows hedge, right? So accounting looks a bit straightforward, but then importantly we want to spend some time understanding also how to do the similar accounting when it is a fair value hedge. Okay, now in this case what you need to observe is that my hedged item as well as hedging instrument, both movements shall be transferred to the P&L. Okay, so when I say I'm categorizing that hedge as a fair value hedge, the objective is that my day one transaction is still nil, my month one transaction goes like this. So let's use the space like this. We say debit forward contract 45454, the same entry, credit P&L. Okay, that's the whole perspective. But now with this hedging instrument coming into picture, okay, we also have a mirror image of the hedged item coming in the picture as well. Okay, essentially we say there is a notional loss which arises because of this particular commitment. Okay, so the idea is that we shall book a loss and we call that purchase commitment as a loss at the same, as a liability at the same time. Now the very objective, where the idea of doing this transaction is simple. We are saying that while the contract has resulted into a liability, there is an offsetting asset through my hedging instrument there. So the hedged item becomes a burden, but the hedging instrument offsets that particular burden or of that particular loss which is recognized around the same time. So that is what is the differential when you look at a hedge of a foreign currency risk. In a fair value hedge categorization, everything would sit into the P&L around the same time. There is no sitting in the OCI context there, right? The same thought process is applied here as well. So you would see this 49784, we do exactly the same entries, debit forward contract 49784, credit P&L 49784, likewise debit loss purchase commitment 49784. Basically it is completely removing that so-called as the P&L volatility here so far, right? At this point in time, now we again purchase the inventory. Okay, so when we are purchasing that inventory, exactly the same thing comes in. We shall be paying the same amount, 1095238. So let's use this space. We are saying that this is fair value hedge. Let's use this spaces. We don't need this information anymore, just to bring that mirror image. So this inventory remains pretty much same. Debit inventory, credit bank 1095238. Right, but at the same time we have this forward contract that is basically my hedging instrument and the corresponding gain sitting on there at the same time. So what we need to understand here is that my forward contract would be reversed. So would be the case with my this, the moment I reverse my forward contract, I recognize a gain here. So we say that I realize that money of 95238 and I say my forward contract is of course matured now. It's cancelled at this point in time. But with this purchase commitment, which is a credit, I need to offset that as well. So what I'm saying is debit purchase commitment and credit. Now this of course gets adjusted against the value of the hedged item, that is my inventory. So this 95238 eventually starts impacting my inventory at this point in time. Now here what you observe is, while at this stage my inventory still sits at 1095238, here my inventory value is coming at 1 million. So that is one clear impact that you observe when you look at cash flow hedge versus a fair value hedge here. Okay, after this the life is simple. When you are actually selling this inventory, exactly the same transaction would come, but if I say I'm selling it, debit cost of goods sold 1 million, credit sales which is 1.3 million. So of course my gain or losses would be correspondingly arising in at this time, the way we did it here as well. We did not recognize any gains or losses here. We are not doing it here either, but importantly what we are trying to understand is that while there could be a firm commitment with respect to a foreign currency risk, the hedging may be done using a cash flows hedge versus a fair value hedge. The choice is available. My documentation shall clearly specify what kind of hedging am I intending to do, and my accounting transactions would take this kind of a shape here. Okay, now the bigger thing that you need to kind of observe here is that any changes in the OCI will eventually hit my value of inventory once that cost hits my P&L, right? Until then, of course, it sits in the OCI, that till that point of maturity as far as my accounting is concerned, right? So that's it from my side for this particular section. Thank you very much. Good day. Take care. Bye-bye.